Welcome back to Commercial Real Estate Secrets. I'm your host, Austin Hare, and our guest today is Matthew Ricciardella. He's the managing partner and CEO of a private equity real estate fund called Crystal View Capital. Now, they've got approximately $200 million in assets under management right now. They've been operating since 2014, and they specialize in mobile home parks and self-storage. Matthew, thank you for coming on the show today.
Thank you for having me, Austin. I'm excited to be here with you.
Yeah, so tell everybody, what part of the country do you live in and operate in?
Our corporate headquarters is here in Las Vegas, Nevada.
Very cool. And so were you born and raised there, or how did you end up in Vegas?
No, actually, I'm from New York originally, the
Hmm.
Catskill Mountain region, and I moved to Southern California at 19, 20 years old, and lived there for about 10 years, and moved to Las Vegas in 2010. Been here ever since. Love it here. I have a wife, two kids, and it's a great place to own and operate a business and to raise a family.
Nice. Okay. So why did you go from New York to California to begin with?
Um, I guess, the reasons you see when you're a kid, you watch movies, you watch TV, and you see the beach, and the grass is always greener on the other side. Being from the East Coast, I wanted to see what would be possible if I moved out to California. And I went ahead and did that. I did that, and it was a great experience for me. Actually, got started as a realtor in
Ah,
Southern California back in 2002, and started my business and started prospecting, making cold calls, and knocking on doors. And really, that was the foundation for what our business does today and how we source off market deals. So built up a real estate business as an agent, did really well, transitioned into home flipping and buying smaller commercial properties back in 2005, 6, 7, 8 in Southern California. Did well during the crash, was able to buy some deals, didn't lose any assets. And I moved to Las Vegas again in 2010. The reason I came out here was I bought a chain of gas stations from a lender
hmm.
and turned them around, built the businesses back up, bought them at a super deep discount, and then sold those investments off a couple of years later. That was actually back in 2012. And decided I did not want to get back into that business.
You
It was
got burned out a
great
little
real
bit.
estate. Yeah, it was a great real estate play, not so great on the operational side. So I wanted to go back to my bread and butter, which was commercial real estate, and specifically the niche of self-storage and manufactured housing, which I bought my first park and storage back in 2006 and love the cash flow that they generate.
Was this pre
And
or post the market crash?
I started buying these properties pre-market crash, and then during market crash and post-market crash.
How were you able to avoid ending like getting upside down on the debt? I mean, were you just paying like steeply discounted rates when you were acquiring them? Because a lot of people that were in real estate in that time frame had to declare bankruptcy. A lot of people that were acquiring properties, a lot of people that were fixing and flipping. They're buying these properties at the assessed value, or even if you got a little bit of a discount, like the market saw a 40% correction. So even if you bought a 20% discount, a lot of people found themselves underwater and had to take a bath. So how were you able to avoid that?
Yeah, no, it's a great question. I think it speaks volumes to the investment strategy. And the investment strategy is buying at a discount to replacement cost, and buying with a value add premise. And what that means is we identify assets that are underperforming or non-performing, and we create value. And what that means is we identify where the issues lie, whether that's below market rents, whether that's a bloated expense base, whether that's high vacancy. And we basically have a team that goes in there. In the beginning, it was me personally and my wife, which was the team. But we add value to those properties and we make them worth more in a short holding period. So to answer your question, even though asset values dropped, our cash flows didn't drop. And these two property types actually perform better in a down market. People are more transient. There's
Mm.
more of a demand for storage. In mobile home communities, there's more of a demand for affordable housing. So we actually saw an increase in our occupancy. So again, to answer your question on that, Austin, Our properties continued to sustain. They continued their current occupancy. They continued their current cash flow levels where there was no issue making a debt service. So we didn't lose any of our investments. In fact, they actually did better in a down market, and we made it out the other side. Continued to invest, continued to employ this strategy that worked for us, and here we are 14 years later, and we're doing it the same thing, just with more scale and in this fund structure versus doing it personally.
So how, back when you were in California, what was it that made you decide that you wanted to be a real estate agent? You said residential, right?
Yeah. Well, it's kind of a funny story. So I went to college, couldn't cut it. And I thought to myself, what career could I enter into where I could make the most money without a degree? And identified a sales agent as the best place for me to start. Jumped all in, and just kind of made it happen.
As you said, you were going door to door, just knocking on doors?
Correct. Yeah, picking up the phone, calling people, asking them if they have any interest in selling their property, knocking on doors, finding listings, finding buyers, and that's how I built my book of business.
So one thing that just pops into the top of my head is the fact that people, it seems like today, are much less likely to answer the phone than they were back then. I mean, we have so much, your caller ID says, oh, it's a spam call, or it's just like, most communication is done via text and email. And so it's like, especially like the millennial generation, but they're becoming more and more of the people who have houses, right? Like they're becoming more and more of the affluent generation just as they age. And so do you still use the same kind of tactics? Like, are you still physically calling people, or do you switch more to like, text and emails and that sort of thing?
Well, so back when I started, obviously it wasn't an issue. We're going back almost 20 years ago.
Yeah.
But to answer your question today, where it's more relevant, yeah, we do texting, we do email, but I'll be honest with you, there's nothing like creating a personal connection and building rapport with another human being. And I think technology has been fantastic. It's made us all more efficient. It's helped me tremendously, but it can never replace the face-to-face or over the phone interaction with another person. Being able to take their temperature and understand what motivates them, understand what's important to them, and to position yourself as a problem solver. So I don't ever think a text or an email could substitute that.
I agree.
So we continue to call. We don't have issues. We've got technology which allows us to call people on their cell phone. And we're not, this is not a cold call in the sense that you think about it where you get these spam calls. This is more a call peer to peer. So I own a storage facility down the street from you, Austin. You're one
Oh,
of
really?
our targets. No, just to give you an example.
Oh, okay.
So,
I
when
thought
I
you meant
call
literally.
you, yeah, not, I might, I don't, where are you located?
We're in Orlando, Florida.
Okay, no, I don't have one
Okay.
down the street. But to go back where the point that I was making, when we pick up the phone and we call a prospect, it's not so much, here's a spam call, we want to lower your car insurance. This is a call of, I'm a fellow owner, typically in the same market that you're in, and we just so happen to want to buy more storage facilities. And we could chat on and connect at an individual basis because we could discuss the business, the industry, what's going on in the marketplace. And it's, oh, by the way, we're looking to buy more. Have you ever thought of selling? And a lot of these
Okay.
relationships aren't cold. I've been calling a lot of these prospects for 15 years. So it's almost like picking up the phone, and I'm almost a friend at that point.
Yeah. I
It's
guess
not
there's a lot less of the or mobile home park owners than there are residential homeowners. I mean,
That's right. You can never have that level of connection with every residential homeowner in the United States. And not to say we have that level of connection with every mobile home park and storage owner, but a lot of them we do. And, we've built a relationship, we've built rapport, and we've positioned ourselves as a problem solver. And we have a reputation of doing what we say. So when folks are ready to sell and they want to transact, it's important to transact with a company that can get things done. And that's what we've been able to do.
okay. So you were calling people, you're knocking on doors, and you said that essentially you found you were successful in getting deals below market a little bit, and then did you acquire a team around you at that stage?
No, at that stage, it was really a one-man band.
Okay.
That's kind of how I built it up. As we scaled a little bit, I brought on a couple callers that helped, an assistant, but it was really a small team. But we did a lot of great things with that team. We bought a lot of properties, flipped a lot of properties right before the downturn, made a lot of money, and it was a lot of fun.
Yeah, that's cool. And so um, it sounds like some point between 2002 and 2006, you had switched from residential single family homes to mobile home parks.
Yeah, it was about 2007. We were across the board. We were doing office and industrial, multifamily, self-storage, mobile home parks, and I kind of gravitated through operating all the different asset classes. I gravitated towards mobile home parks and storage just because I liked the free cash flow that they generated. I liked how we could buy them and how we could manage them and how we could create value. Not that you can't do all of those things in the other asset classes. I just saw more of a niche for my skill set in these two property types.
Okay. So do you mind talking about that a little bit? Because you mentioned earlier that you're getting underperforming locations. And so there's a myriad of reasons why a mobile home park could be underperforming. But what are some things that you look for? And then what do you do to get them generating more cash?
Yeah, no, it's a great question. Some of the things that we look for is fragmented ownership. Non-professional operators, and what I mean by that, not that they're not good operators, but they only have maybe one or two locations. For us, we have a corporate office that oversees, 30, 40 locations. So there's some synergies there. We have some infrastructure and systems in place that the typical one-off, one location owner operator wouldn't have. But those specific things that we're looking for are occupancy issues, lack of marketing, below market rents, deferred maintenance. And what we do is identify specifically what those issues are. We step in, we put a plan in place to solve those issues, whether that be painting, new roofs, new clubhouse, new paving, pools, general cleanup. Every instance is a little bit different. Sometimes it's buying mobile homes, bringing them and filling vacant sites, selling them, filling occupancy. Sometimes it's as simple as rents are 20, 30% below market. We'll make those improvements and bring those rents to a market level. And by doing that simple act, you're creating sometimes hundreds of thousands of dollars of net operating income that falls to the bottom line that when you place a cap rate on it, translates into several $1 million of value, which you could create sometimes in a very short holding period. So if done right, if the assets are bought properly and if they're managed properly, you can make a lot of money in this business. But
do you have a preference?
Not the faint of heart.
Do you have a preference between buying and holding versus flipping?
No, I think really wealth is generated long term. That's not to say you can't buy an investment with a little hair on it, create value and sell it off and make a nice residual pop. We do that. But my preference would be to hold long term,
Okay.
to have rent growth year over year, increases of net operating income and cash flow year over year, and be a long term holder.
How often are you doing seller financing versus bank financing?
Well, in the beginning, I was doing a lot of seller financing. And the reason for that is banks didn't really want to lend on the product type. Now that's changed and the tables have flipped where banks love the two asset classes. So there's no problem procuring debt for self-storage and manufactured housing. On manufactured housing, Fannie and Freddie are typically the lenders of choice. On storage, it's either life loans or CMBS. We rarely get seller financing. Now it's more of an accommodation to the seller. And now considering how much liquidity we have, if it's a situation where we're not going to get bank debt, we typically will just pay cash.
Oh, really? Okay. After you pay cash, will you refinance later with the bank?
Typically. So if a property is non-performing or underperforming and it's not stabilized, what we'll do is we'll buy it for cash. We'll go in within a year, typically, we'll have it stabilized. We'll go back to the bank, get an appraisal with the new value and get, 60, 70% loan to value on that property.
So do you have an ideal kind of park that you require? Because, there's obviously the number of units, the number of spaces. There's also the types of rental. Like you mentioned, you sometimes rent the units, sometimes you just rent the lots. And then there's also the capacity. If you've mentioned that they're 30% paying under rent, I mean, that seems like it would take some time. I'm guessing you have to wait till their leases are up before you can bump the rent up on them. And so, like, between all those different factors, I mean, what's like, when you look at it, what's like a slam dunk for your fund, like your niche?
Yeah. So answer your question on the leases, most leases are month to month or annual at the most. So there's
Okay.
not a long, that's one of, in my opinion, that's one of the attributes that's quite compelling to the asset class comparative to, let's call it retail or industrial or office, where you have to wait long term for those leases to roll over to increase rents. Here you could do it almost immediately. But to answer your second question of what's a bread and butter investment, or what kind of checks all the boxes, if you will, for us at this point, the larger the better. We're looking for large property types, typically $10 million plus. Let's call it 300 lots plus, self-storage, 100,000 square feet plus. And where they're somewhat operating.
You said, sorry, how many lots did you say?
300.
300. Okay.
Yeah, where they're somewhat stabilized, but let's say rents are way below market and there's some deferred maintenance and there's some small things we could do to basically breathe some new life into the property and make it perform a little better. That's really what our niche is. The real heavy lifts where we want to do a ground up development, or we want to add on to an existing storage or mobile home park, I should say. And there's a lot of deferred maintenance, and let's say there's infrastructure issues. Not that we're against that, but that's a lot more challenging process than coming in and solving some inefficiencies that can be solved within the first 12 months to create a lot of value, which is typically what we've done and what we've had success in.
Okay. So how does that translate into cap rates? Like, because there's two factors. There's the like pro forma cap rate, which is what you could get it at after bumping up leases and doing whatever. But there's also the current cap rate that you would buy it at. And so, like, do you have a goal in terms of what you look to buy it at and what you look to stabilize it at?
Yeah, so every market and every product type based on quality of asset is going to command a different cap rate within the market. We don't have, let's call it a benchmark cap rate that we have to buy at or anything of the sort. But typically what we're underwriting to is 25+% internal rate of return over the life of the investment. A lot of our investments have ranged. Some of the cap rates that we're buying at are as high as 8, and then we could create value on top of that and turn it into a 10+ cap rate. A lot of the larger, more institutional type investments, that's not really going to happen. Sometimes we're buying at a 4 cap, but we're able to take it to a 7.5% cap within 12 months. And there's nothing wrong with that. It's very difficult to get a 7.5 cap in these two investment classes in this marketplace right now. So typically these assets are trading at from 4, 5, maybe 5.5 caps. So if you could take an investment to a 7.5 cap in its first year, depending on its size, you're creating a lot of value right from the start.
So you're buying it at a 5.5 cap. You're improving the structure, increasing the net operating income, and it's stabilizing at a 7.5 cap or so.
Sometimes, sometimes it's more, but as an average, I would say that that's a fair statement.
Or I guess there's like a couple percentage points in margin from the value that you create. Okay. Yeah, that's interesting. And so what you said you kind of target 25% internal rates of return?
Yes.
And is that like, how does that, because you said you got a fund that you're raising money for, you have a fund in place, 25% return, is that split between the general partners and the limited partners, or how does that work exactly?
Yeah, so that's a fund level return. And let's say you get a 25% return on one investment, and that fund has, let's call it 20 to 30 different investments. So you'd have to blend all of those investments together. And when you actually liquidate the fund and start selling off assets, then there'd be a split between the general partner and the limited partner per the terms of the documents. So we underwrite based off a fund level return, but generally speaking, that's probably going to shake out in the range of a 20% return for our investors or our limited partners.
Okay. And you're talking about annual returns?
So an internal rate of return is based off the life of that particular investment. So that's going to take into account a sale. So a cash on cash return is probably more in the range for us of 10, 12%. We pay an 8% preferred return to our limited partners. And both our funds, Fund 2 and Fund 3, we were able to service that 8% preferred return for every quarter. And our first fund has gone full cycle. So what that means is we've raised the fund, we've purchased investments and sold all the investments off.
Okay.
And that's resulted in roughly a 44% return to our limited partners.
Okay, that's great. What was the time frame on that?
So that had about a 6.5-year life.
Okay, cool. Do you know what would that break down to annually?
If you were to break it down, it'd be about 44% return per annum.
Oh, per annum.
Yeah.
Okay.
Yeah. So the internal rate of return basically.
I thought you were saying over the lifespan it returned 44%, but you were returning 44. It equated to a 44% annual return over the 6.5-year period.
When you take into account the sales, yes, but the cash on cash in the beginning wasn't at that level.
Right, no. Right.
But for easy math, what I'll say is this: basically, we had a 2.5% multiple of invested capital to our partners, and what that means, Boston, is every dollar they gave us over the life of the investment, we gave them back $2.50.
That's great. Yeah, that's a really great investment for them.
Yeah.
Okay, so that was your first fund, and then I'm guessing a lot of those guys probably rolled over into was it at that stage your third fund?
Oh, that would be our second fund. Yeah. So most of our Fund 1 investors reinvested in Fund 2. Now you're seeing Fund 2 investors making large investments in Fund 3. And Fund 3 is a $95 million equity raise. We've raised about 60. Nice. So that's almost fully subscribed. We have commitments for another 10 million. So I would say by July, that fund will be fully subscribed.
And what's the minimum that you guys take?
50,000 is the minimum investment.
Okay. And then do you have like a timeline for that one that you're shooting for?
Timeline in terms of,
like you mentioned, the last one was about 6.5 years from the start to finish. Do you have a timeline similar to that if you're going to sell any of these locations, or is it the plan to hold indefinitely?
Yeah. So, being opportunistic, we really don't have a set wind down date. So it's not as though it's a 10-year vehicle. It's an evergreen fund, meaning it's open-ended and it can continue on. It obviously won't continue on forever. I've always been a proponent of selling when optimal market conditions warrant. So when
like right now.
Yeah, that's a great statement. Yeah, right now is a great time to sell. Absolutely. But I hate having a set window, because let's just say we had a 6, 7, or a 10-year fund, and we're in a situation 8 years from now and it's similar to the meltdown of 2008, 2009. What a shame it would be to have to sell in that type of environment, especially if your assets are still performing. As I mentioned, mine were back in the last recession we had in 2008 and 2009. So I would rather wait until optimal market conditions warrant than sell off investments to provide our investors with the best returns.
Right. Yeah, and that makes sense. So in terms of the funds that you're putting together, you mentioned that there's multiple locations. About how many different parks are you trying to agglomerate into one fund?
We're not really looking for number of parks or number of storage. It's a good question. question, nor do we have a specific mandate to allocate a percentage of parks and storage. We get that question a lot from prospective investors, or, what's your targeted allocation of manufactured housing and storage? We're very opportunistic. So, we're going to go where the opportunity lies, regardless of if it's a park or a storage facility. I will say this: in Fund 2, it was about 60% manufactured housing, 40% self-storage. But to answer your first question, typically what we're looking to do is deploy our equity capital. And what we're looking to do is put $95 million to work. However many deals that shakes out to, I'm not sure at the end of the day, but our typical deal size is 5 to 10 million.
Okay.
So I would anticipate somewhere in the range of 30 investments once that equity capital has been fully deployed. But we're looking for scale. So it's actually the least amount of deals we could do, probably the better, because those larger deals are going to trade for a premium in terms of a cap rate, because you're going to go to more of the institutional investors and the private equity shops versus smaller retail investors when you go to liquidate and sell off your investments. And by the way, it's a lot easier to manage fewer assets as well. So by no means do we have a goal to have many multiples of self-storage and manufactured housing communities. We'd actually prefer to have less but higher quality.
Yeah, that makes sense. And when you say $5 to $10 million per deal size, is that like the amount of money that's required as the down payment, or is that to purchase the entire property?
Yeah, good question. That's been our average for this year, to buy the entire property. So we've got some deals that are 16 million, 10 million, 13 million, and then we've got some smaller deals that are in the $2 million range. So on average, it's about 5 to 10 million. The equity check is typically $1.5 to $2 million.
Okay.
In our typical equity check.
So yeah, at $10 million deal, you have 95 million in equity, and you're using bank financing, you could get actually a lot more than 9 or 10 deals.
Well, yeah, that's why we're assuming about 30 deals.
Oh, 30 deals. Okay. Yeah, that makes sense.
Yeah.
And so, when you come into these, you take them over. I mean, you got to have, are you hiring your own staff to manage the self-storage and the mobile homes? I mean, how often do you keep existing managers in play?
Yeah, so it just depends. Sometimes you'll find these opportunities, and there's nothing wrong with the on-site management. They perhaps may have had poor leadership, and we could keep that relationship and keep them employed, and then hire them under our new banner, and then basically have them follow our strategies, our procedures, operate more efficiently, and then answer to our corporate office. And we've had a lot of managers that we've inherited, and they've been 10-year plus relationships. Other occasions, the on-site team just won't work. There could be theft issues. There could be just personality conflicts where we have to replace the on-site team, bring in our own team that's been trained by us. Sometimes it's a relocation. Sometimes it's a fresh team that's never worked for us. But the key is we get them to follow our strategies, our procedures, and that's what makes the properties perform to their maximum.
And who makes that decision? Are you like interviewing these people personally, or do you have a team that does that?
We have a team that does it. I make the final decision. I get involved in the interview process, but I will say we have a fantastic team here at the corporate office. They do a lot. They do all of the training, quite frankly, on the asset management side. They do all of the recruiting. They'll come to me and tell me, hey, I like this team and here's why, and we'll have a discussion. And typically I'll go with whatever team they think is going to be the best fit.
Okay. And so, past several years, I've been hearing a lot about mobile home parks and self-storage units, and they become quite popular. So I can imagine it's getting pretty competitive. Do you have any idea, what is the market size? Like how many, different mobile home or manufactured homes, whatever you want to call them, parks are there in the US?
Yeah, there's actually more than 50,000 manufactured housing communities in the United States. But the thing is, most of them won't be targets for Crystal View Capital. The reason for that is they're going to be too small. We've identified roughly 8,000 targets, and What those are lot sizes of 150 plus. Those are going to be our marquee targets. So that's kind of what we're going after. For self-storage, quite frankly, the number continues to rise because there's new supply continually coming to market. So that's more challenging to gauge. But right now we have about 14,000 targets on the self-storage side. So we've got about 22,000 targets nationwide that we're actively pursuing on a daily basis, putting deals together with.
Okay. Okay. Yeah, that makes sense. So, yeah, it's really interesting. And then, the other thing that we're seeing right now, just macroeconomically, is the increase of asset prices everywhere. There's just so much cash on the sidelines. I mean, everybody's trying to deploy, everybody's trying to get a good return. We had this issue before coronavirus, and then after coronavirus, the pandemic, the lockdowns, we thought maybe the cash would dry up, but it didn't. There was so much stimulus money that's been printed and so much liquidity in the markets. And so, it's got to be hard to stay competitive. Like, we've obviously got inflation on the rise. I mean, I think we had 4% inflation in the month of April, which was one of the record numbers from over the last several decades. So are you accounting for this? Are you paying, competitive rates, or is your goal to, just get it for the best price possible?
Well, when you say competitive rates, I'm assuming you mean on the debt finance side, right?
Well, I just mean on the cap rate side, like when you're acquiring them from the owners.
Okay. Well, I guess it's a multi-layered question, and it's a good one. And it's certainly one that we think about a lot. First off, on the inflation side, the Fed has come out and said that this 4% inflation is transitory. I don't know if that's accurate or not. There's a lot of factors at play.
Mm-hmm.
If you look at these lockdowns and people have this pent up demand, and now the supply chains are disrupted, so it's obviously created a bottleneck where prices had to go up perhaps beyond what they normally would go with, let's call it 1 or 2% inflation, but that's a whole different discussion. But your point's well taken. There's a ton of liquidity in the system. It's all looking for yield. Interest rates are at or near zero, so they're starved for yield. And what that means is that cap rates are coming down, because investors are willing to pay more and more to achieve that yield. They're willing to take on more risky investments. You look at junk bonds, and the spread between the treasury and a junk bond, it's at its lowest point of any time in history, because again, investors are just starved for yield. And what our investments provide is yield. So that's very attractive to investors. And we do have to compete with these larger groups that are out there, and they're willing to pay premiums, prices, quite frankly, we couldn't afford to pay because of our cost of capital compared to theirs in the public markets. But we do have one ace in the hole, Austin. And that is, we know about these deals and they don't. So we're not competing with 18 different potential buyers on an investment. We're competing with maybe 2 or 3, or a lot of times 1, just us, because it's built upon that relationship. And therein lies the majority of the value and the alpha that we deliver to our investors.
So a lot of the places that you end up acquiring are maybe they're older people, they're older mom and pop couples who haven't really explored in depth wanting to sell, but you've built a relationship with them, and so you're kind of the first guy that they go to when they're ready for that.
That's correct, generally. And a lot of these more mom and pop places, they don't want to deal with an auction process. They don't want to deal with the Marcus and Millichaps of the world. That's not a knock on Marcus and Millichap. We use them to sell some of our investments, and I think they're a great firm. But the point is, they don't want to go through the traditional broker channel and the auction process. They want to deal with a buyer that is proven to execute, and they want certainty of execution. And we've positioned ourselves as that buyer. And when the time comes for them to transact, they typically want to work with us. And I think it's a win-win relationship for both sides.
That's great. Okay. So, for anybody listening, they want to get involved, or they want to reach out, ask more questions, maybe what's the best way to get in touch?
Yeah, so you could visit our website, www.crystalviewcapital.com. If you'd like to make an investment, you could email Allie at our investor relations department. It's invest@crystalviewcapital.com. Or you could reach our corporate office at 702-507-1607.
Great. Okay. Yeah. Well, I wrote that down in the show notes for everybody listening. So I will put that in there. But yeah, this has been awesome. I'm sure it's been educational. It's been educational for me at the very least. And I like your guys' strategy. So right now, everything's competitive. We got so much cash. We got inflation on the horizon, or some would say we already have inflation happening before our very eyes. And so a 25%, IRR rate of return, you can definitely be competitive to outperform inflation by a long shot. And so I think what you guys have going on is really cool.
Yeah, I appreciate it. We're really pleased with our performance and our team. And if anybody's interested in hearing more, I encourage you to reach out. And thank you for your time as well, Austin. I enjoyed it.